Hi everybody, I'm Jeff Barton and this is the Mortgage Minute. Appreciate you watching. We're on LinkedIn, Facebook, Instagram, number of other social media channels. So let's get right to it. It's Monday. A lot of things happened over the weekend and last Friday. As everyone knows, taper has begun, and the scaling back of bond purchases as well as mortgage-backed securities by the Fed has begun, and that's going to cool some of the mortgage markets eventually. Currently, not so much. Rates are still pretty good. What are the rates? 30-year fixed rate today is at 3.07, the 15 years at 2.48, 2.63 for FHA, 3.04 for jumbo, and 2.75 for the 5/1 ARM. The 10-year is at 1.5%, a 10-year bond. That's going to be the indicator that we will be watching when we see what happens in the markets as we get further down the line and more months pass and the taper gets stronger and stronger. We're due to end the taper probably mid-June next year. The Biden infrastructure bill passed, bipartisan. Now, that's a good thing. It shows some people that they have faith in what the government is trying to do. Fill the potholes, build better roads, fix some of the water. These are all high corporate interests. Both sides, the Republican and Democrat, wanted it. Therefore, it passed. That's a good thing. Some of the bad things, what's happening here as far as the what the Fed thinks about the interest rates and what they will do next year. We're looking at interest rate hikes. That is the borrowing percentage that the Fed lets member banks borrow from, usually the discount window, the overnight window as well. All of these things have to do with liquidity and how much money you have to have in your bank in order to be able to satisfy the liquidity requirements that the Fed imposed since 2008. Those are bad things, and they will cool the market a lot faster than the taper. The taper itself was a way by which to stimulate the real estate sector, which it did, kept rates low, which it did, fueled the housing market, which it did. That being over, the next thing to control both the economy and the overheating of the economy, which could happen, is the interest rate, and which also happens to control the inflation. The inflation rate itself will come down as soon as the rates by the Fed go up. The borrowing rates by member banks go up. Inflation will go down because tightening of the credit standards as well as the liquidity in the markets to be able to lend out will obviously control what inflation does. A couple other things going on. The adverse marketing fee has ended and did end, but during that 10 months that it was around, or 8 months, whatever it was, the Fannie and Freddie made about $5.3 billion. Was supposed to offset the losses they incurred, but the accounting is yet to be done. But that $5.3 billion came directly out of the consumers' pockets. Wall Street investors versus the mom and pop shops. Since iBuying went down, as everyone knows what happened with Zillow. Zillow was buying houses at one number, fixing them up, and trying to sell them at another number, i.e. they're trying to make money on house flipping. Well, it backfired horribly, and on Friday Zillow said, hey, you know what, we're out of the business. But what does that mean to those people who are looking at institutional buyers versus the mom and pop buyers? There's a lot of rhetoric online about that. If you go to any of the major, whether it's MSN, whether it's CNBC, whether it's Bloomberg, or whether it's your generic Yahoo, there are articles that are in favor of institutional buying. I'm not, and I'll tell you why. I think it's one of the quickest and best ways by which a savvy real estate investor can make money and perhaps dig themselves and pile up the money so that they too can join the wealthy classes that did it through real estate. When institutional buyers come into the marketplace, it's an all-cash buyer. What else? There's some other things here. They're all-cash buyers. They are, right, they have the money to fix up, and they can fix up. So therefore, it freezes out individual investors from being able to take advantage of maybe a position that they might be able to get into, or 1,000 different investors. I think that's better for the economy, don't you? Anyway, The labor participation rate is at 61.6%. During or before COVID, it was about 81 to 83%. We still have about 4.5 million people out of work. The Fed interest rates, the shale's coming online, so we're going to finally see some relief from gasoline prices, although probably not through the winter because, as everyone knows, when you are mining now, most of that gets refined to home heating oil, not gasoline. But we will see relief probably in the spring. Up 5.5 minutes for my Mortgage Minute. I'm Jeff Barton. This has been the Mortgage Minute, and we'll see you tomorrow.